Myth number 4 of buying a home, 4 or 5. You should always get a mortgage from the bank you have a checking or saving account with. Now, this one off the top of my head, this means it's like, no, why would you? But I can see most people thinking, yeah, I've been using TD Bank for 30 years. At least talk to them. And if you've been doing them, stick with what you know. That makes the most sense. But you gotta do your homework, man. So, Angel, let me ask you, how common is this to make it a myth?
I think today, in today's world, this is a huge myth. So let's look back to banking and lending 50, 60 years ago. You're exactly right. You had a bank that was right down the road. It was convenient to get to. You knew the bankers, you knew the loan officer, they went to church with you, et cetera. And that was your bank. You did everything there. Anything that dealt with lending money or putting money on deposit, that was your bank to go to. Well, in today's world, the benefit is between the big banks out there, the little community banks, the credit unions, the online banks, everybody's competing for those deposits and loans. So as a consumer, I think it definitely benefits people to look at their situation and not just default to, well, this is the bank I've gone with and, I've had an account with ever since I was 14 years old. So I'm always going to do my loans with them. It could be financially smarter to do it with a different lender, bank, credit union, you name it, that you might not have a traditional banking relationship with.
Okay. Yeah, that makes sense. So comparing mortgage rates, different banks give you different rates, different mortgages, read the fine print, common mistakes. I probably don't know any of them because I've never looked at a mortgage agreement, but what are common mistakes I'm going to make when looking at mortgage rates?
So a lot of things when you look at the original mortgage rate is, one, what is the actual cost to get that mortgage, aka origination fee? Some lenders will get you with, hey, we'll get you 5.1%, whereas every bank's at 5.3%. But maybe they require 2% of your loan to close. So if it's a $400,000 loan, you got to pay $8,000 to get that rate. So origination fee is a big one. Second is, again, the ability to buy down points. So that's a common term that lenders use where, again, you can prepay more money at closing to get a lower interest rate. But you have to look at the math, the numbers to make sure it makes sense. So the interest rate dynamic is not always as black and white of, hey, I got 5.3%. There are also factors on getting the loan, closing on the loan, and then the PMI equation as well. Every lender is going to be different. One lender might charge $150 a month for PMI. Another might charge $30 a month. So those are all important things to get. And one of the most important factors to figure that out is when you get pre-approved, when you put in an offer, the loan officer or banker you're dealing with is going to give you a closing document that's going to have all those fees, all those terms on there. So you're aware before you sign on the dotted line and buy that house.
Yeah. So when you're shopping around for a mortgage rate, instead of sticking to one bank, obviously you want to look at the interest rate, look at upfront fees, I guess maybe taxes. Is there anything else that we're missing that you should, when shopping around, going from bank to bank, use a negotiating tool? Like, hey, Citibank down the street's offering me this. Can you negotiate how much room is there for negotiation, or is their terms pretty set in stone?
Yeah, there can be some negotiation, again, with the ability to buy down points, which oftentimes you can even get that if you're buying a home from someone who's selling it. So a lot of times, here's a benefit is instead of asking for a $10,000 or $15,000 reduction on a home price, go to the seller and say, hey, are you willing to put $10,000 into my closing so I can get a better deal on my lending rate? And that's a very popular strategy where that seller will say, okay, I really want to sell my house. So sure, I'll give you 10 grand at closing. We're going to sell the house at the listing price, which is a benefit for the realtor. But then for you as the buyer, woohoo, I just saved me 0.2% because now I got the money to buy down my rate. So those are all important factors to look at. The benefit to shopping around today is just how business is done. 99% of banking is done online. Everything's digital. So you could have a bank that's across the country that you have your loan with. You never physically have to go into that bank and you can have a loan. And that's the advent of the Ally banks and Capital One Financial. Some of these where, again, they don't have physical buildings, but they loan products. You can have savings accounts, et cetera, because of the ease of being able to do everything online. So that's another factor of, hey, to administer this mortgage, to get this mortgage, does it make your life easier, or is it more of a pain depending on which vendor you use? So if it's more of a pain, maybe it does make sense to use your bank you've always used.
That makes a lot of sense. And when it comes to negotiating, you're dealing with three fronts here. You're dealing with the homeowner, the bank, and the realtor, who all want you as most of your money as possible. So if you're smart, you can kind of work within the system and work with the three of them, again, not against each other, but with and against each other, for lack of a better term. So that's interesting. And then yeah, like if I want to use a bank from Delaware, where $400,000 is a lot more in Delaware than it is in New Jersey, in most places. So that's actually a really good tool. Shopping around doesn't need to be stuck to local. You can go national.
Absolutely.
So that's good. And then credit scores. Credit scores are the most important thing, or at least they're up there when applying for loan, interest rates, and all that. So will different banks view your credit score differently? Like, is a 750 credit score at Citibank different from a 750 credit score at Capital One?
It very well could be, which I always tell people it's good to know kind of what their lending standards are. But generally, for the most part, yeah, banks are going to look at what we consider excellent credit, good credit, average credit, et cetera, and make their rates. So the term they use is risk-based lending in that case, where, hey, if you're a 680, you're in this zone, maybe from 620 to 719, where you're going to get this rate because you might be higher risk. Whereas if you're a 720 or higher, 740 or higher, you're going to get our best rate, et cetera. So generally, they're going to be pretty close. A lot of those credit reviews are going to be similar from bank to bank when you do go to get a mortgage. But the key thing is you definitely, if possible, before you apply, if you can be 740 or higher, that's going to definitely give you the best rates, not only on mortgages, but on any loans too.
Break down the key differences between a fixed rate mortgage and adjustable rate mortgages known as ARMs. ARMs, you got two of them. So why would you choose an ARM over a fixed, and just give a quick definition of each?
Yeah, so fixed rate mortgage being, again, for the length of that loan, 15-year, 30-year, that interest rate is locked. It is not going to change. An ARM, an adjustable rate, gives the lender or bank or credit union the opportunity to raise that interest rate by, oftentimes it is going to be capped at 1% per year. And oftentimes that ARM is going to be a 3-year, 5-year, 7-year ARM, meaning your rate is fixed until you get to that period in time, 3, 5, 7. Where we see an ARM oftentimes used over fixed is depending on the interest rate environment, credit spreads, and if we think, because there's no guarantee here at all, that interest rates may be level or go down over time, sometimes the ARM makes sense. The other case, like we talked about beforehand, is if somebody's buying a home with minimum down payment, oftentimes the lender may require you to have an ARM instead of a fixed rate. And maybe it is a little bit cheaper. So a fixed rate might be at 6.2, whereas an ARM's at 6%. So oftentimes, even from your cash flow, it makes sense for you big time. But the adjustable rate mortgages absolutely can be a mess. And we saw that back in 2007, 2008. That's what got people in trouble, where at the time in the early 2000s, these adjustable rate loans were very competitive compared to fixed rate loans. And it was because at the time, the lending standards allowed the banks to raise whatever they wanted, 2, 3, 4% per year. So all of a sudden, as interest rates went up and as people hit their ARM renewal period, 3-year, 5-year later, their mortgage rate could have gone from 4% to 9% within a month. And the bank's saying, here's your next payment, due next month. So adjustable rate loans are definitely something that people need to really have a plan if they're going to use them, and know what to expect in those circumstances.
So it really depends on the strength of the market with the ARMs, the adjustable rates, because especially a period like now, 2025, where it's volatile, like the entire market is volatile. So, if the Fed raises rates, you can expect a higher rate. But at the same time, you don't want to lock in a high rate. Like, you don't want to lock in a 30 years at 8.5%, when if you had an ARM, it could be down to 4%. So you really, you're really rolling the dice, and it completely depends on the strength and faith you have, the strength of the market and the faith you have in it. So, damn, that's a lot. That's a lot to consider.
Mm-hmm. It is. That is for sure. Yeah, it's not always cut and dry. That's for sure.
Damn. Okay, I'm making my heart just skip a beat. So let's move on to FHAs and VA loans and who qualifies for these programs. So lay it out. What are FHAs? How do VAs, and how do you qualify for them?
Yeah. So Federal Housing Authority, FHA loans are generally, again, going to be zip code dependent. So oftentimes it is used for investment in very rural, poorer parts of the country. So again, if you buy a home, it's incentivizing economic stimulus, if you will, in very rural areas. The biggest benefit are with FHA loans that are, again, very low down payment requirements. Oftentimes it's 2% or 1% a loan. VA, Veterans Administration loans, are similar for military personnel, so active duty and or past duty military. Very similar benefit. Usually you get a little bit more breadth of what you can buy and what qualifies, but the biggest benefit are good terms, very low origination costs, and also, again, minimum down payment requirements.
All right. And then first-time home buyers. Any specific loan types for first-time home buyers that they should prioritize over others?
Yeah, I would say if a first-time home buyer, if you're able to get an FHA loan and it checks all the balances of where you want to live, what you want to do, absolutely go with that. I think, again, those are great loans to go with. The other thing with first-time home buyers is to look locally of what type of city, county, state assistance programs they have out there. Certain states have programs to incentivize first-time home ownership. They may be income-based. They may be geographically based on where you want to live. So those are all things to consider. But again, having a good lender to work with should know those programs, and they should be able to point you in the direction of saying, hey, your income is X, or maybe you're a first-generation American, you could qualify for these programs, et cetera, that, again, can make home ownership and buying that first home a lot easier for a lot of people.
Yeah, subsidies, loans, like whatever you can qualify for. Do your homework, and certain banks might know more than the other banks or offer certain things for first-time home buyers to take that pressure off. So, yeah, I think it just totally makes sense. At the end of the day, yeah, do your homework. Don't just stick with the TD Bank because you've been using it since 2006. But finally, credit unions. What about credit unions, and how do they differ from banks, and in terms of what their benefits and downsides could be in terms of mortgage lending?
Yeah. So credit unions, again, the term is they're owned by the members. So you can't buy stock in a credit union like you can with Bank of America, Citibank, et cetera. So the general emphasis here is, hey, they don't have to share their profits. They're spread with stockholders. So oftentimes they're able to do one of two things for its members: lower loan rates and or higher deposit savings rates. So that's where you often hear, hey, a credit union is going to pay you better rates on a money market account than a publicly traded bank like Wells Fargo or Bank of America. So oftentimes that's where most people go to credit unions. The other big benefit too is sometimes, not always, sometimes their actual loan process can be easier, more streamlined, and more cost effective too. So you don't have a lot of the red tape and ancillary fees, costs associated as you will with some banks. But again, that's not always the case, but with some of them that might be the case.
Interesting. Yeah, I didn't know about credit unions. I don't know much about credit unions as much as I know about finance and money and stuff. Credit unions is just like, well, man, they exist. I know that.
That's right. Yeah, unless you're in the weeds of them, that's right. You hear them, you see their signs, and that's about the extent of it.
It's always good if you know someone who knows something, you can teach them something new. So that is a win for this session already. So you should always get a mortgage from the bank you have a checking or savings account with. That myth is capital B busted.
Yeah, capital B busted. With you.